The broadcast is now starting. All attendees are in listen-only mode.
Good morning, good afternoon, and good evening, everyone. Welcome to today's Drewry's tanker shipping webinar sharing session. Today with us are Rajesh and Anshika. They are leading the tanker shipping research team in our research team, and myself from Drewry Advisory. Before we start sharing of the tanker shipping markets, I would like to introduce briefly about what we do in Drewry Maritime Advisory. So as we are, in addition to our research team, who is publishing the research market reports on a regular basis, Maritime Advisory team provides bespoke service to various of participants in the shipping markets, such as ship owners, charters, terminal operators, as well as financial institutions. We are covering 4 different sectors, including oil tanker shipping, gas tanker shipping, dry bulk, etc. Plus, the areas of expertise we're covering includes but not limited to market outlook, market strategy and planning, due diligence reports, as well as financial advisory parts. So I would like to share with you one case study to show what we are doing in terms of advisory service. So the attack is what we have done for one of the largest national oil company for Southeast Asian area. The company is looking for some strategic support to develop their portfolio of optimal fleets, and they want to expand into different sectors on top of what they're currently working for. So what we have been helping them to do is to evaluate what is their tonnage requirements, as well as looking at their compatibilities to make a suggestion on what type of markets or what type of ships they should venture into investments. And moreover, we have also provided the strategic organizational suggestions to them, and provide our suggestions for their optimal portfolio of vessel type and numbers, etc. So we have achieved quite positive results. The client is very happy with our analytical outcome, and they are it has been largely adopted and implemented afterwards. Okay, without due more delays, we would like to let me hand over the floor to Rajesh, who will start with the crude tanker market developments. Rajesh, over to you.
Thank you, Serena. Hello, everyone, and welcome to this edition of Drewry webinar. For the next 15-20 minutes, we'll be taking you through the Drewry's view on the crude tanker and product tanker market outlook. So, at the moment, tanker market is at very interesting juncture, wherein product tanker rates, they are feeling pressure of the fresh influx of fresh tonnage. At the same time, we are seeing some change in fortunes for VLCC market especially, and that in particular because of the recent unwinding of OPEC production cut. So we have seen like a high degree of volatility in tanker market rates for the last 3 years, starting with the market disruption in 2022 with the onset of Russia-Ukraine war. So at that time, because of shifting trade patterns, the rates surged in both crude and product tanker markets. The 2023 was a bit of normalization from the highs of 2022. Then again, with the start of Red Sea crisis in 2024 or towards the end of 23, we saw a surge in product tanker rates, especially the LR tanker in the LR tanker market, and the extent of surge in the rates were that high that attracted some of the crude tankers like VLCCs and Suezmaxes into clean products trade after cleaning the tanks. Now, after that, like this year, with the start of fresh tonnage influx in product tanker market, rates have softened from the highs of 2024, but nonetheless, they are still attractive as per historical standard. On the other hand, in the recent months, or rather in the recent weeks particularly, we have seen a sudden surge in VLCC rates especially, and the VLCCs were like competing with the mid-sized tanker, especially after the Red Sea crisis, which lifted all of a sudden the demand for mid-sized tankers due to shift in trade pattern and Russia exporting its crude to Asian buyers, which led to an increase in mid-sized tanker demand, whereas VLCCs, because of the Asian demand for Russian crude increased, so it displaced the demand for VLCCs, which resulted in relatively lower rates for VLCCs. Now there is a change in fortune for VLCCs. Now, with the unwinding of production curves by OPEC Plus members, voluntary production curves, the rates are gearing up and they are inching towards the $90,000 per day mark. Now, on the asset side, if you see, we have seen a slight softening in the new building prices this year from the highs of 2024, but they are still very high. Similarly, in the second-hand market side, with the decline in the charter rates, asset prices have gone down from the highs of 2024. Now, it will all depend on, especially assuming that going forward there will be fresh tonnage influx, especially in the product tanker market. There will be some pressure on second-hand prices, but for crude tanker, the prices might still fare better than the product tankers, especially considering the inventory build in the market that might keep the rates relatively better as compared to product tanker market. Now, if we see the supply side of the dynamics, we can see the stark difference between the crude and product tanker market. In product tanker market this year, we have seen a surge in fresh deliveries, and on the other hand, in deliveries in crude tanker market, they are still subdued. Although like deliveries, demolitions are still subdued, we have seen a significant decline in ordering in product tanker market just because the order book is still very strong and there is still uncertainty regarding the IMO carbon tax. Now, if you see the overall growth impact of this thing, we can see strong deliveries for product tanker market in 2025 and 2026, which will lead to a surge in product tanker fleet So fleet is expected to increase around 9% this year, then another 6% in 2026. So that obviously will put pressure on rates because we don't see any similar growth in the demand. On the other hand, if you see the VLCC, although deliveries will inch higher in 2026, the overall fleet growth will still be around 2%. So that will still be very significantly lower as compared to product tanker market. So if we just analyze the supply side of the market, crude tanker market seems still better positioned as compared to product tanker market. Now, there has been, like in the recent months, we have seen a surge in the VLCC rate in particular, and that is primarily driven by the oversupply in the crude tanker market, oil market rather. Now, with the speedy unwinding of voluntary production curve by OPEC members, the oil supply has outpaced the demand. In the fourth quarter, we'll see further surge in the inventory buildup, which will again rise in first half of 2026. Now, this sudden surge to the tune of almost more than 4 million barrels per day in the first half of 26, that is based on assumption when OPEC members, they'll keep the production at the October target levels. Now, in the recent meeting, they are planning to unwind another second tranche of the production curve, which took place in April 2023. That is around 1.7 million barrels per day. So after unwinding 2.2 million barrels per day of voluntary curves by September this year, there'll be another, if there is further unwinding of production curve to the tune of 1.7 million barrels per day, the inventory build, or you can say oversupply, will be even higher than what we are seeing in the first chart. Now, that will have a severe impact on the rates in the crude tanker market. One, initially because the current inventory levels, they are lower, so there will be inventory buildup. But this level of inventory buildup, eventually onshore storage will be full, and it will put pressure on the oil prices, and that might lead to the contango in oil prices, which again might give rise to floating storage in the crude tanker market if producers don't balance the market. Now, if we see the level of inventory buildup historically in 2020, when there was a sudden drop in demand due to COVID-19, overall inventory buildup was 2.4 million barrels per day. Now, if we see the current with the current level of production, or rather October 25 level of production target for OPEC, there will be around 2 million barrels per day of inventory buildup in 2025 overall, and most of it will be in the fourth quarter. Then again, there will be a surge in inventory in 2026 as well. Now, although this 3.3 million barrels per day of oversupply in 2026 looks more than what we saw in 2020, but in 2020, especially in the first half, the actual inventory buildup was around 7 million barrels per day. So that was way higher, and that led to price going to briefly going to in negative territory, and all the onshore storage were full, and there was huge surge in floating storage at that time. That resulted in a sharp increase in the crude tanker freight rates despite the sluggish or weak demand. So we are like eyeing the similar level of inventory buildup over the 2026, provided if there is no, you can say, production cut from outside OPEC or OPEC. So it will be interesting to see how the OPEC producers or non-OPEC producers, they take stance going forward once the oil prices starts going down and inventories reach onshore storage reaches towards the capacity. Now that will decide the fate of the overall growth in crude oil trade. In 2025, we assume like around 3% growth in trade, just because of then sudden increase in the inventory buildup towards the end of the year, despite almost like modest growth in oil demand, which will be around 0.7%. Now, the 2026, the trade growth will entirely depend on the level of stocking activity or level of the overall oversupply in the market. So the longer OPEC producers or other producers will take to rebalance the market, we can see rates going up, especially in the first half of 2026. And if there is no action from the producers, we can see elevated rate throughout the year also. Now, if we see the forward market, we can see a surge in FFA rates for fourth quarter 2024 and first quarter 2026. So that will purely be based on the oversupply in oil market and stocking activity, whereas because demand growth will not be that high. If we translate this spot rate into time charter equivalent, the time charter equivalent will be well above the 60,000 per day mark in fourth quarter and first quarter of 2026. Thereafter, the FFA suggests that there will be a gradual softening or normalizing in rates. Similarly, if we see the calendar spread in the third chart, the spread between calendar 26 and 27 assessments, it has widened in the recent time. And if the inventory levels keep growing and then onshore storage becomes full and there is any increase in floating storage because of contango in oil prices, in that case, we will see further widening in the spread between calendar 26 and 27, because 27 rates will surge like anything. Now, it all depends on the overall oil production. If we go by the current target of OPEC plus members of unwinding this 1.7 million barrels per day production over the course of 2026, we can see a significant surge in inventory and floating storage, and that rates can touch the roof in such a situation. Now, there is three possibilities if we consider that other producers, whatever we are expecting the production growth in non-OPEC producers, say Latin America, US, if that remains constant, and for any reason, like if there is no further pressure on Russian oil production, in that case, unwinding of additional 1.7 million barrels per day of voluntary cuts, that will lead to a surge in floating storage, and we can see rates rising to the level similar to what we saw in 2020. On the other hand, if OPEC plus members, they keep the October targets, the production around October targets, in such a scenario, oil prices again, because of the oversupply in the market, will remain in contango, and that will give rise to floating storage, because even in such this scenario, without further growth from October levels, we'll see huge inventory buildup throughout the year, and we can certainly say at the extent of growth in production that will result in a surge in floating storage. However, if there is some action from the OPEC Plus members, or maybe if there is any chance of decline in production from Russia or Iran because of sanction pressure, in that case, maybe the rates will look similar to what FFAs are suggesting. Otherwise, we see a significant surge in the charter rates and spot rates in the crude tanker market, especially in the first half of 2026. Now, considering the historical tussle between the shale oil producers and OPEC producers in 2025, there was a sudden surge in oversupply in the market, and then again at that time also there was huge inventory buildup. I think at some point of time, once there is storages are full, and in that situation, oil prices will go down significantly, and once that producers will feel the heat of lower prices, we think that eventually there will be rebalancing in the oil supply, and which might, you can say, normalize the freight rates in the crude tanker market. So that's all from the crude tanker side. I'll hand over the floor to Anshika. She will discuss about the outlook for crude product tanker market. Anshika, over to you.
Thank you, Rajesh. Talking about the product tankers, as we can see in the first chart, the product tanker fleet growth is set to surge not in just 2025, but there is a significant increase in 2026 as well. So this rapid fleet growth actually outpaces the seaborne trade growth of refined product, which will reduce the tonnage utilization and will weigh on the rates. Due to an increase in delivery, which will weigh on the fleet growth, while on the other side, a decline in vehicular fuel demand due to a rise in EV sales will weigh on the demand side. The exceptional high rates in product tanker market due to Russia-Ukraine war, Red Sea crisis, and a thin order book will not return, while but we expect the product tanker rate to decline in 2026 well below the last 5-year averages. Now I'll talk about the two key events which has happened and will impact the product trade flow in 2026. The very first key development is EU 18th sanction, which is set to shift the diesel trade pattern. So EU 18th sanction package has banned the import of refined product made from Russian oil, directly impacting Indian diesel import. So if I talk about the last 2 years, historically the European diesel trade flow has been undergoing a massive change. For example, in 2023, just after Russia-Ukraine war, Europe replaces Russian diesel import from India and Middle East. In 2024, Europe boosted US diesel due to Red Sea crisis, which increased the voyage length and leading the region to near sourcing. At the same time, it reduced the India's and Middle East import volume a bit. And now again, in 2025, with EU 18 sanction, we expect the European diesel trade flow to change again. As this sanction will come into force from January 2026, we expect the Europe to decrease the Indian diesel imports. At the same time, in second half of 2025, we expect likely that there are chances of inventory buildup by Europe, as they are currently experiencing a historically low level of diesel, and thus the region can actually increase the inventory level by increasing the Indian diesel import before the ban actually come into effect in 2026. However, going forward in 2026, we expect the east to west LR trade flow to reduce. At the same time, if Europe replaces this reduced shipment by increasing Middle Eastern volume, it will offset the decline. Now, the second development is, okay, so yeah, the rising China's naphtha imports. So as you can see in the first chart, China has tremendously increased naphtha import in the first half of 2025, increasing well above the last 5-year average. And what is driving this increase? There are basically 3 reasons behind this surge. The first is massive ethylene capacity expansion by the country, and out of which 70% of this capacity rely on naphtha as a feedstock. So the crackers can use either LPG or naphtha as a feedstock, and a huge ethylene crackers are dependent upon naphtha, and thus they are increasing the naphtha imports. The second is the trade war impact, the US-China trade war, which has happened recently, and thus China is continuously reducing the dependence upon US LPG. So far this year, China has imported, the US share is only 37% in LPG import, while last year it was 51%. The third reason is because of the supply, a better supply security in naphtha, because it can be sourced from a varied sources relative to LPG, which is much more concentrated. And thus we expect China to continue increase its naphtha import in coming year. Although South Korea and Japan, which are the major importer of naphtha, has been facing a decrease in operating rates due to a depressing petchem margins because of an global overcapacity led by China. We expect going forward, China will drive the naphtha import. At the same time, South Korea and Japan volume will remain stable. Summarizing the product tanker discussion so far, what will drive the market? There are both upside and downside. I'll start with downside first, because there are surge in deliveries and it will outpace the demand growth. It will reduce the rates. At the same time, rising EV fleet will again cap the demand growth. The third downside risk is a rise in refinery run in product importing country. For example, Dangote in West Africa, which is reducing the Europe to West Africa gasoline flows. On the upside, we have rising sanction on tanker. Currently, more dirty tankers are sanctioned as compared to the product. However, in 2026, if there is an increase in product tanker sanctions, it will be positive for mainstream product tankers. The second is declining refinery runs, which will outpace the decline in oil demand in West, especially in Europe, which will increase the trade and will support the rates. Third is because of an attractive rate in crude tanker market, it will entice the product tanker owner to switch into the dirty trade, and hence will reduce the tonnage supply in the product tanker market and will support the trade. So that's it from my side. Thank you so much.
Thank you, Rajesh and Anshika, for your presentation. Okay, maybe we will have time to answer one question. If I may ask you, Rajesh, on the crude tanker perspective, do you think there will be any shift in the trade pattern because of current high US tariff on India? Rajesh, over to you.
Thank you, Serena. So as far as like crude tanker trade, just because of US tariff is concerned, so far we have not seen any significant decline in Russian crude imports by India. So Indian government, despite the additional 25% tariff, Indian government is persisting with Russian crude imports. Recently, the gap between Russian crude prices and Dubai crude prices that has widened, which is another incentive for India to import, continue to import Russian crude. But considering the fact that there will be a supply glut in the market in 2026 especially. So going forward, if this supply glut gives opportunity to US administration or EU to further tighten the sanctions on Iran and Russia, in that case, obviously, overall supply glut, which we are expecting, that will not be to that extent. So in that case, any decline in crude production in Russia or Iran might lead to overall slower growth in trade as compared to the current situation. But all in all, there at the moment, just because of tariff, we don't see any significant change in the seaborne trade of India. Yeah.
Over to you, Serena.
Okay, thanks. Sorry, I was muted. Okay, thank you everyone for your attending for today. I hope to see you in our next webinar sharing session. Have a nice day and evening ahead. Bye-bye.
Thank you, everyone.
Thank you, everyone.
Thanks.